Did you notice something extraordinary that happened today? Three of the world's most powerful central banks, the Federal Reserve, the European Central Bank, and the Bank of England, all fired policy signals within the same 24-hour window. The Fed delivered a hawkish hold with the most dissenting votes in 3 decades. The ECB held rates but spent what Christine Lagarde called a very long time debating when to hike. Sessions, something interesting appears. Around the 1.1645 area, repeated waves of determined buying have emerged. These buyers are defending a level that carries enormous weight, the 200-day simple moving average, which currently resides at 1.1676. This moving average is acting like a magnetic floor, and so far, it is holding. The 14-day RSI is hovering around 48, telling you that the bearish momentum is present but completely lacking the kind of runaway conviction that typically drives a clean breakdown. The ADX is sitting near 22, confirming that trend strength is modest and a catalyst is still required to trigger the next leg. Up above, the first major resistance is the 50% Fibonacci retracement at 1.1747. If the euro can muscle through that ceiling, the next objective becomes the 38.2% retracement at 1.1826. Down below, the immediate support is the 200-day moving average at 1.1676 itself, followed closely by the 61.8% retracement at 1.1667. Should both of those fail, the bears will quickly target a deeper decline toward the 1.1555 region. In plain language, the euro is currently running inside a mildly bearish technical structure, but both bulls and bears are waiting for a fundamental detonator to blow this range wide open. Now pivot across the channel to the British pound. Sterling stole the show during the European afternoon. Immediately following the Bank of England's policy announcement, the pound against the dollar exploded higher, surging around 0.6% at its peak and punching all the way up to the 1.3550 area. The Bank of England voted by a crushing margin of 8-1 to hold the bank rate at 3.75%, exactly as forecasted. But Governor Andrew Bailey's words at the press conference were anything but neutral. He explicitly warned that in the face of the current energy price shock driven by the Middle Eastern conflict, waiting for second-round inflation effects to become visible before acting would be a serious mistake. The currency market instantly translated that statement as aggressively hawkish. Sterling overnight index swaps now price in approximately 73 basis points of rate hikes from the Bank of England by year-end. That is essentially 2 to 3 additional quarter-point moves. Look at the 4-hour chart for cable. The pound is now trading comfortably above both the 20-period moving average at 1.3513 and the 100-period moving average at 1.3501. The RSI is at 61, exhibiting healthy bullish momentum with room to run before becoming overbought. The price is currently prodding the horizontal resistance at 1.3561. A clean break above this level would expose the swing high zone between 1.3575 and 1.3600, an area that has marked the very top of the 2026 range. On the downside, near-term support sit at 1.3535 and then at 1.3517. Now let me stitch together the fundamental fabric that gives these charts their meaning. Today, Thread 1 is the euro area. The European Central Bank kept the deposit rate unchanged at 2%, the refinancing rate at 2.15%, and the marginal lending facility at 2.4%, all fully in line with consensus expectations. But during the press conference, President Christine Lagarde dropped a clear signal. she disclosed that the Governing Council had spent a very significant portion of the meeting debating the precise timing and conditions for a rate hike, explicitly guiding that June is now a live possibility. On top of that, Eurozone harmonized consumer price inflation for April accelerated to 3% year-on-year, up from 2.6% in March and hitting its highest level since September 2023. If energy prices continue to feed into core inflation, the ECB will find it increasingly difficult to justify staying on hold. However, there is a painful dilemma embedded here. The same war that is pushing up energy costs is simultaneously crushing economic growth. This is a classic stagflationary trap, and it is the fundamental reason why Madame Lagarde has not pulled the trigger already. Thread 2 is sterling. The Bank of England's hawkish hold was more direct and less ambiguous than the ECB's. An 8-to-1 vote and Bailey's deliberate warning about second-round effects tell the market that the old lady of Threadneedle Street is not unwilling to raise rates further, she is simply choosing her moment. If energy-driven inflation persists and the June data prints hot, a hike at the next meeting is practically a done deal, and the market is now toying with the probability of 3 moves this year. Thread 3 is the dollar's own multiplying challenges. Last night the Fed produced 4 dissenting votes and Jerome Powell admitted the policy bias is shifting toward neutral. And that was only the first half of the dollar's problem. Today, news that both the ECB and the BOE are preparing to potentially tighten over the summer has injected a new dynamic. For the first time in 2026, the market is seriously pricing a scenario where 2 of the dollar's biggest G10 rivals begin closing the rate gap. If the Federal Reserve is politically boxed in by the ongoing White House transition, the trade war with China, and the military entanglement with Iran, the dollar's rate advantage faces a systematic erosion. You can see the immediate effect on your screen. The US dollar index has retreated from above 98.60 to the 98.16 area, a drop approaching 0.8% on the day. Now I will give you 6 strategies, 3 for each currency pair plus a professional cross-rate trade, all engineered to turn this 3-way policy collision into managed, risk-defined profit. Strategy 1. The beginner approach for Euro to US dollar. The Euro is currently consolidating around 1.1660, with a 200-day moving average providing a natural gravitational pull. You do not jump in blind. You wait for a pullback entry into the 1.1635 to 1.1650 zone, a region that corresponds with the lower boundary of the 200-day moving average support band. Set your hard stop loss at 1.1590. This gives you sufficient room below the 1.1600 round number while ensuring that if the 200-day moving average is convincingly violated, you are out with a controlled, measured loss. Your profit targets come in 2 stages. Book half the position at 1.1720 and let the remainder run toward 1.1780. Total risk on the trade must not exceed 1% of your trading capital. Strategy 2. The intermediate Euro to US dollar trader uses implied volatility. You can construct a long strangle ahead of the ECB's June meeting. Buy a slightly out-of-the-money call with a strike at 1.1850 and simultaneously buy an out-of-the-money put with a strike at 1.1450, both expiring around the meeting date. Your thesis is not directional. It is that the euro is coiling inside a tightening range and will produce a violent expansion in either direction when the ECB finally moves. The maximum loss is limited to the premium spent, while the payoff asymmetry is extremely attractive. Strategy 3. The professional euro play. targets the repricing currently underway in European fixed income. 2-year German bond yields ticked higher after today's ECB statement. You can execute a cross against the Swiss franc. Go long the euro against the franc, entering around the 0.9700 level. The rationale is that while both the ECB and the Swiss National Bank have historically been dovish, the SNB is now passively trapped near negative rates, and the widening rate spread between euro-denominated and franc-denominated short-term debt favors euro strength. Place your stop at 0.9560 and target 0.9880. This trade also provides valuable diversification away from a pure dollar-centric view, moving to the British pound. Strategy 4, for the beginner. I know it is extremely tempting to chase the pound right now at 1.3550 after that explosive post-BOE surge. Do not do it. The correct approach is to wait for the pullback and the confirmation test. Your optimal entry zone sits near 1.3480, which is the area of the 100-day moving average and the pre-decision consolidation floor. Set your stop loss at 1.3390. Your profit targets are 1.3580 for the first half and 1.3650 for the second. Position size must again be limited to a maximum of 1% risk. Strategy 5, the intermediate pound trader, can deploy a risk reversal option structure. Sell a deeply out-of-the-money put at 1.3200 to collect premium, and use the proceeds to buy an out-of-the-money call at 1.3800, leaving you with a net cost close to zero. Your foundational judgment is straightforward. Under the Bank of England's newly asserted hawkish posture, the pound's downside is likely contained against the pound. The euro to pound sterling cross is currently trading near 0.8662. Today the ECB and the BOE both sounded hawkish, but the market is already pricing roughly 2 to 3 rate hikes for the UK this year, while the ECB's expected tightening is a much shallower 0.75 of a percentage point at most. The near-term rate differential is tilting in sterling's favour. You can consider shorting euro to pound sterling in the 0.8680 zone, placing your stop at 0.8770 and targeting a move down to 0.8520. This is not a bet on euro weakness in absolute terms, it is a relative value expression that sterling will outperform the euro over the immediate policy horizon. Now I need to hammer the risk warning bell, and I need you to hear every word of it. First, the Eurozone stagflation risk is real and it is deepening. If economic data deteriorates further while inflation remains sticky, Christine Lagarde may very well be forced to abandon her June hiking hint entirely, and the euro would be punished severely. Second, the Trump administration's suggestion of a short-term ceasefire between Russia and Ukraine could crystallize into real negotiations. If genuine peace talks begin, the energy price risk premium that has been underpinning both the euro and sterling's hawkish repricing would evaporate, and both currencies would give back today's gains in a violent rush. Federal Reserve System. If his first remarks exceed the market's expectations for hawkishness, the dollar could stage a sudden and brutal revaluation that hits all G10 pairs simultaneously. So here is today's bottom line. 3 central banks spoke in unison today, and the message was clear: the era of an unchallenged, unilateral dollar rally is being questioned. The euro is hovering at a policy crossroads, waiting for one clear shove to break out of its consolidation. The pound is already going to break it wide open. I will see you tomorrow.